It's my pleasure to introduce the next speaker, Roberta Romano, who is a professor, a Sterling professor at the Yale Law School. And she's also the director of the Center for the Study of Corporate Law. So Roberta is really one of the leading scholars worldwide on the intersection of financial markets, finance, and law, and has extensively written about issues in corporate governance, takeover regulation, security market regulations. And I think one of the themes in the conference that came up yesterday was that somehow maybe the industry, asset management industry, or the finance has somehow failed its promises to society and to investors. And at various points in time, people have pointed towards regulation and regulators. And sometimes we feel maybe there's too much regulation, sometimes there's not enough regulation, maybe it's the wrong type of regulation. So it's really a pleasure to have Roberta join us, who will speak about the topic of how to get regulation back on track. Roberta, thank you.
Thank you very much, Geert. I'm delighted to be here on this wonderful occasion for the Finance Center, which I've been associated with for a very long time since I've been here. I've got a much more limited objective than Andy Lowe had. And so to keep your attention and interest, since I can't, my topic's certainly not as interesting or important on some dimensions, I wore a color to wake you up. Right? And so we're in red today. As Geert mentioned, my topic is on how to get financial regulation back in track. And just to give an overview of my remarks, I'm going to first give an overview of what I call the iron law of financial regulation, which is, I think, a core regulatory problem we have with financial regulation. And then I'm going to advocate two procedural mechanisms to try to mitigate this problem, which are sunsetting review and fostering regulatory experimentation. If time permits, I'm going to take as an example of the iron law of the Volcker Rule of the Dodd-Frank Act. And so that's where I'm going. And let me first start with an overview of the iron law of financial regulation, each of which I'm going to go into a little more detail shortly. My argument here is that foundational financial legislation is enacted in response to a crisis. And this is not just a US phenomenon, it's a general phenomenon. And it's adopted then at a time when there's just a lack of information about what the problem was, what caused it, and how best to respond. The other factor that we have to bring in here is that our very topic, financial regulation, two of the words that Andrew mentioned has connection to, of course, cancer and scientific research and funding it, is dynamic uncertainty and innovation in financial markets, which makes it difficult to regulate even in good times when we have information compared to in the midst of or aftermath of a crisis. And that means error is going to be inevitable in what we do, but financial regulation is sticky. The net result is there's a one-way regulatory ratchet over time in response to a continuing set of crises that can produce costly policy mistakes that have unintended consequences. And we get over time an increasingly opaque and burdensome regulatory apparatus that becomes less effective. Okay, so that's the overview of the iron law, and let me provide some detail. So first, crisis-driven. So the US Congress invariably has only enacted major financial regulation of securities markets and banks after crises or stock market crashes. We can think of the fundamental rules for securities law in the 30s, as well as Glass-Steagall, a bunch of banks. The Federal Reserve was created back after a series of banking panics as well. Sarbanes-Oxley, the most overarching reform of regulation of the securities markets and corporate governance since the 30s was adopted after the Enron and other accounting scandals with the stock market crash in 2000, the summer of 2002 when it was adopted. and so forth, Dodd-Frank after the most recent one. And why does that occur? Well, there's immediate clamor to do something. The public wants something done here. I once sort of was tracking news reports after Enron and those collapses of a demand, not just to do something, but the government has to do something and not the private sector and the like. And politicians also feel the need to respond. They have to do something. It's seen as a concern, particularly if these come at our periodic election cycles, that there's a concern if we don't do something, we may not get elected. But the problem, of course, with doing something in a crisis is that it's too soon to understand what actually needs to be done. But this is human nature as we know it. So I'm not going to advocate, well, just don't do anything, because that would make sense, and let's wait until we have information, because that's just not possible. We know what people are like. And so I'm going to be arguing for procedural approaches to deal with the fact that we know we're going to have something come up and be adopted at this point in time where we don't have adequate information to do that. Second, I sort of want to build in the other sort of problem that makes this an area that's particularly tricky to deal with, and that is we have increasingly large and interconnected financial institutions producing more complex instruments, financial instruments. And that means, and this is sort of what we've heard in our previous talk, risks are not just known, but there's unknown risks and unknowables, and we don't know where the risk is going to come from, market players as well as regulators. In addition, the uncertainty is dynamic. So this is sort of what people talk about who are interested in terrorism and the like, comparing sort of natural phenomena like hurricanes, or, well, they're not a good example. Earthquakes is probably a better example, where the probability of occurrence of an earthquake in Connecticut is extremely remote. But if it happened, it would be very catastrophic. Well, we can build buildings to be strong enough, right, to resist earthquakes. Does that affect the probability of an earthquake? It's unlikely. Maybe some human activity does, like the dam in China, right, on the Yangtze. But in general, we don't think nature responds to what we do, as opposed to in terrorists, right, there's uncertainty about, it's remote. Are we going to have another 9/11? We can adopt rules now that you can't bring a paper cutter aboard an airline, but that means the terrorist is just going to do something else. Now, we know they're going to respond, and here sort of we're thinking about bank regulation. We know sort of we impose higher capital requirements. Banks will respond because we know they want to avoid or reduce their cost of capital, but we don't exactly know how they're going to respond. Now, I'd argue these are responses that can be nonlinear. So that means it's very complicated to sort of predict what's going to happen. The uncertainty is dynamic. As we try to respond, who we're trying to regulate, the regulated respond in ways that we can't anticipate. And so that creates a problem that it's very challenging to predict what would be the impact of a regulatory or legislative action or legislation to be implemented by regulatory action, and where future problems lie. What will create the next significant tail risk or systemic risk? Compound that with the fact that regulation is sticky. Now, in the US political system, all legislation is sticky because we have a system devised to be that way intentionally of checks and balances, so there's many veto points in the legislative process. But I think in financial regulation, it's especially sticky because it's a very technical topic, so the public doesn't pay much attention to it, right? And they're ceded to experts, so you don't get sort of ways of Congress sort of thinking about doing something in general. And then if we think about sort of regulators, your incentive is not to do much and not to sort of go back and think of what you've done, in part out of risk aversion. If we've adopted some regulation in response to a crisis and we got rid of it and then the crisis hits again, it's going to be our fault, right? If we have a catastrophe, if nothing happens and we don't have prosperity, well, it's not seen as a regulatory problem necessarily, right? As well as sort of there's a lot of psychological literature with experiments and the like that people tend to have a bias in favor of the status quo and not sort of changing it. Right, so we have that aspect, human nature, as well as the political system that we've adopted. And this creates a problem because we're dealing with a context that requires change. If we think about a dynamic economic financial market, right, things are going to change. Right, so we thought about, originally the Basel rules had, now this was political, but they had a low capital requirement for residential mortgages. Now we understand why they did that. That was because governments wanted to promote housing. But back when that was adopted, right, in the early 80s, we didn't have a lot of subprime mortgages. Most people were putting a lot of money down, so they seemed less risky than corporate loans. Right? We didn't change those rules, and then that market developed, right, to have more risky loans. right? But the Basel rules, right, the government, they're not readjusting those rules, right? So we have a context where whoops, I want to go back one, where, I guess, we cannot act nimbly, right, to revise things when we need to do that. It requires change. And let me give just one example from sort of US sort of regulatory history. So the Glass-Steagall Act, which everyone knows in the 30s, separated commercial and investment banking. Well, nobody, even the Volcker rule that I hope to have some time to talk with, nobody thinks that that was the reason for the financial crisis and that we need to go to back that, who's informed about anything about financial markets and institutions. Right? And there had been research on Randy Krasner and Phil Strahan and others showing that actually the banks that did the best during the Depression were the banks that actually had investment activities and weren't just commercial banks. Not surprising, they were larger and more diversified. Right? And so there had been a long line of research and general consensus that that particular division wasn't really a problem. Right? But did Congress respond? It took decades before that was repealed. Of course, if you're changing regulations, you have to take sort of other things into account about what people do. But my point is that it's very difficult to change regulation and legislation in this context, in a context that actually requires nimble updating. So what is the output of a crisis-driven legislation that I've been talking about? Well, if we go back to this context, what we feel we have to do something when we lack information. Well, congressmen then are looking for solutions that are readily adaptable. So it's like if your sort of luggage is lost at the airport and you need to go and speak at a conference like this, you can't get a bespoke suit, right? You're going to have to take something off the shelf that may not fit very well, but it's something that you can do right away. And that's what we find in this context. So you get a lot of recycled proposals that people have hoped to get on the agenda, right? And for some reason or another, they didn't come up. But now we can get it on the agenda if we can make some connection to some politician maybe that we're connected with to say, well, maybe this sounds right, and they can put it forth and get it through because they need to do something, and this sort of fits their purpose. So we get off-the-rack, ready-to-go proposals, right, that may be tangentially at best related to the crisis, right, but they can get them through. An example in Dodd-Frank was say on pay, allowing shareholders to approve in advisory votes on the executive's pay package. Right? Now, it's hard to sort of believe that anyone, even if we think about sort of, I've argued about incentive compensation for bankers, that the reason of the financial crisis or was connected to the fact that shareholders didn't approve their salary. There had been bills, one introduced by then Senator Obama, to sort of have this required vote that got nowhere. They couldn't even get co-sponsors in both houses. But this got into the Dodd-Frank Act under some view that, well, since incentive compensation of many sort of traders and the like might have been wrong, let's put this up. Right? So these are things that we just find something and it sounds like we've done something and we can relax. The other thing that we see, although we see this in most legislation, right, that's complicated, is an overbroad delegation strategy. Now, one might think that, well, so this is, in other words, Congress says, okay, we have a general rule, and then agencies, banking regulators, Securities and Exchange Commission, you fill out the details. Now, this might sound like, well, oh, they've recognized the paucity of information that I've identified as a problem, right? And so they're really giving us time, right, to do that. But that's not really what we can conclude from how they deal with this. If we think about the Dodd-Frank Act, which had a lot of delegation, over 400 rules were required of agencies. But did they say we're going to take our time? No, they put deadlines. And they expected them to adopt 400 rules within a year or a year and a half of the statute. So they couldn't possibly expect that the basis for delegation was that they'd get more information and learn what was going on. And so political scientists have sort of tried to give explanations for delegation. And one thing that seems more plausible in the context of thinking about how Dodd-Frank's delegation worked was that legislators can avoid responsibility if the policy fails. So they've said we've done something, now we're going to throw it to an agency, and if it doesn't work well, which is probably a high probability since we don't know what they should be doing at the time we're adopting the legislation, then when our constituents complain to us, we can say it's the agency's fault, and maybe we could help try to get the agency to stop it and do something for our constituents. But if it turns out okay, then we can take credit for it because it was in our statute. And I think the issue is that this can result in a one-way sort of regulatory ratchet because after all these crises, we just keep increasing regulation that becomes complex and opaque. And the more complex it is, the harder it is for investors to understand what the regulated entities are doing, for regulators to understand them, and therefore it makes the regulatory apparatus increasingly ineffective. So what is my solution to this, or to mitigate this problem? We're never going to solve the complete problem. The first sort of thing on my, that I advocate here is sunsetting. So what do I mean by sunsetting? Sunsetting would say that any financial legislation and its implementing regulation adopted in the time of a crisis has got to be reviewed and reconsidered on a periodic basis. And we need a condition, though, because we could say, well, we're going to, if we review it, then we don't have to do anything. And so the key mechanism, or what gives this bite, right, is that if they don't do anything at the time when this, the time for the review and reconsideration comes up, the regulation and the legislation expire. Right, so that forces you to do something here. Right, so the law or regulation is automatically repealed after the end of the period of the time fixed for its review, unless it's affirmatively reenacted. Now, in the review or reassessment, it doesn't mean this is just a 0-1 or an on-off response. It could, of course, just be reenacted as is, or repealed and gotten rid of. But the idea here would be that it would be revised, and pieces that make sense would be kept as is, pieces that don't would go. But we can refine or improve what we've done at the time when we originally enacted in a period of lacking information. What is this, if we think about this and this sunsetting process, about how it sort of comports with what I've sort of identified as the iron law? Well, I think one could argue that it's particularly well suited for mitigating the iron law. It compensates for the paucity of information when the legislation was enacted, because it permits new information that has come about post-enactment of a better understanding we might have of a crisis. Of course, we can say we may not get that much understanding. If we think about the Depression, people still are arguing about what caused the Great Depression of 1930. So in 2015, do we still think we completely know what happened in 2008? Not necessarily. But it gives us more information than we had certainly when we were enacting a statute a year or so after the crisis or in the midst of a crisis. So that's one important thing, including any unintended consequences that have already emerged or been made visible from the action that we took post-crisis. This also compensates for the stickiness of the status quo, because I've changed the sort of presumption that the status quo stays by saying the status quo is going to be disrupted. Right? So it forces the political process to undertake a comprehensive reassessment of that crisis legislation within a fixed time frame. It will also facilitate then, sort of, if we think about getting more information and requiring a review, it should facilitate responding to financial innovation, right? To new economic and technological conditions, whether it was what's the capital requirement for mortgages or not, right? We can do that more here. And perhaps it might reduce the sort of the resistance that interest groups make to take to sort of implementing regulations that were coming forth from the legislation that's adopted in response to a crisis, because they know that there's a guaranteed reassessment. So perhaps that will help on that. I'm going to skip that for time. Of course, just because we say we have a sunset doesn't mean it will work. In the 1970s, sunsetting was extremely popular. It was a plank of the Carter administration. It was a plank of good governance. Then Senator Edward Kennedy tried to get legislation that would sunset all of the federal government. This was a time when people were worried about administrative bloat. So we think back of that decade of high inflation and the like, and people thought we needed to cut the cost of government. Virtually every state adopted sunset legislation for all of the administrative agencies of the states. Sometimes it worked, but it became very difficult to have it work, and so many states repealed that. Some states still have their sunset laws, or they readjusted their sites, and it was no longer going to review every agency and every program. And so we know a little about what made those programs ineffective and what made them work a little better. So for sunset review to work, we have to have certain kinds of criterion or conditions of it. And so one thing that was clear in the states, the problem that legislators had was how could they review anything? They didn't know what was going on. They didn't have the resources to study the agencies and figure out what programs were working and weren't. So they would just rubber stamp things. And the idea of sunset review ossified, withered on the vine, so to speak. So what we need sort of is to have a panel of independent experts, right, who can then make an assessment and provide information to the legislators about what kinds of programs are effective and what aren't. And sort of the way we sort of adopt this in our process is to be, a bipartisan review panel of independent experts would be appointed by the legislature. This reduces the time that the legislators need to undertake their review because they get information from this panel, right? And it avoids, we could say, well, why not have the agencies undertake the review themselves? Well, we'd be worried about that. Sort of as I've already mentioned, we're worried about a status quo bias in an agency. And so that type of self-review may be less effective than having the outside panel. We could sort of have the agencies do it too, but when we think the outside experts would want to do some of their own analysis of what's going on. One also needs specific evaluative criteria. That was another problem that the states found. Since they didn't know what they were benchmarking to look for, these became often pro forma reviews. Right? And so if we're thinking about sort of something about like the FSOC, right, the Financial Stability Oversight Board that was created by the Dodd-Frank Act, well, we think sort of one of the objectives we want to look at is that reduce systemic risk, right, or how are they regulating them. So that would be sort of a criteria that we would look for rather than looking for something else, right, or not knowing how to focus our sites. Another key factor is having an action timetable so that we have something, some results. So one might be worried about a sunsetting statute to say, well, we think this might be a good law, and some small minority of congresspeople could just hold it up so that it expires and we have a vacuum. Right? So that would be something that people would object to about thinking about this process. So what one needs is to have a time frame that makes that come up. Back in the days when Kennedy was sort of trying to get a sunset idea across, now one of the justices of the Supreme Court, who was then his chief of staff, Stephen Breyer, was drafted a proposal for him, and he put it in his textbook. He was also an administrative law scholar before he became a justice. Although they were not going to change the status quo, they were going to have the president, since Carter was favorable to deregulation, the president was going to appoint this panel that would forever sort of review everything, right, and then put things up to Congress. But they advocated having a timetable. So adapting that idea to my sort of proposal. What this timetable says is that sort of when the review panel goes through its evaluation, it would make some recommendations of what to do about the statute. And that would go to the committee with jurisdiction in both the House and the Senate. Now, that's one of the veto gates where in the checks and balance process, if the committee doesn't sort of get it out to the floor, that could just create sort of the expiration of the law. You need a petition from all of the majority of the members to try to get something out of committee. So what this would do is to say as well, after X number of days or X number of months, when a committee gets the recommendation from the review panel, that if it doesn't put it out itself or some version of whatever it proposes instead, then the proposal of the review committee goes to the floor. Right? So we've gotten rid of that veto gate. Plus, that should give incentives then for that review committee to sort of have a proposal that they think is a good proposal because it actually will be considered. Right? So we're going to do that. And this also then makes the defenders of the status quo, right, have to cooperate. And the ones who want to expire have to cooperate because it's going to go to the floor. And then for the Senate, what we would do is we would use a special rule, right, that would get rid of the filibuster rule, and so that it has to be considered. And this is something that's used in the reconciliation process. The budget process, they can't filibuster. To sort of use our healthcare example, the Affordable Care Act only passed because it was subject to a special rule. There's also a statute that doesn't really work well, the Congressional Review Act, which says that Congress is supposed to get, within 60 days of any major regulation, they're supposed to be able to review it, and then they can pass resolutions to say, we want to repeal this regulation, then it goes to the president. That rule's only been used once, and if there's time, I'll talk about that later. But that rule comes with special procedures to make sure it's an expedited or streamlined legislative process. So this is not a bizarre sort of thing to add. This would make a sunset review more effective. Now you might say, well, how can we sunset anything in this context, right? It sounds weird to think about sunsetting. And let me just give one example. The Commodity Futures Trading Commission, which is the regulatory agency that regulates derivatives, financial products, is actually a sunset agency. It was created at the time in the 70s when sunsetting was big and the Democratic Congress didn't, by then it was Nixon was the president, and they didn't trust him very much in who he would appoint. And so on a periodic basis, Congress is not just sort of talking about appropriations it gives it, but it has to reauthorize it. Has it ever sort of gotten rid of the agency? No. But it's taken the opportunity to revise its operating statute whenever it comes up. I mean, I should also note, has that deterred the sort of innovation of financial products? Derivative innovations was derivatives are a massively innovative field. So having their regulator sunset didn't affect that very much. Let me sort of briefly sort of turn to the other sort of thing that I think is a valuable procedural mechanism in mitigating the iron law. And that is trying to foster regulatory experimentation. It complements sunset review. First of all, sort of now, ideally, this means, what do I mean by this? This means when we're implementing financial regulation, right, that we're going to implement it, trying to do it on a randomized, in the ideal world, we would actually do this as a controlled experiment, right? Like these clinical trials, and some banks would be subject to one rule and other banks the other, and we would see, right, which rule seems to be more effective for stability, right, or for having them take less risk or return and the like. So that's the ideal that we'd want here, right, as part of the implementation of the rule or and the like, right? Now, what would be the benefits of this? Well, this minimizes the unintended consequences of whatever we're doing because only a subset of the sector is going to be affected by that rule. More importantly, it provides us with information about what process might be better than another in terms of getting our regulatory goal, right? So that complements our sunset review because we now have some informed basis for thinking about should we maintain a regulation or not. And it increases then the information that we get about the rule more cost effectively, as I said, if we're doing it randomly. Of course, there is some issues about whether you could do this randomly. So we can imagine, right, political pressure. How can Morgan, I'm the Bank of America and I've got rule A and my competition, Citigroup, has some different rule and it's going to affect me competitively. So that is an issue about that. But we do have one example of financial experimentation. The SEC did an experiment, the uptick rule, which is a rule that said you can't sell short in the market when the price has gone down. You have to wait till the price goes up. Many people, financial economists, had written about this as a rule that didn't make sense, that prevented markets from adjusting to what the right price should be. And the SEC did an experiment run by its Office of Economic Analysis, right, where they randomly assigned stocks that the uptick rule would not be applied to, and they looked to see what happened. And when they evaluated it, it didn't have this hugely negative effect on the stocks that people in the market, i.e. the companies, right, whose stocks these were going to go down, thought they would be, and so that they modified the rule. So this is like the gold standard of experiments. Of course, then the financial crisis came about, and we had this big drop in some of these financial stocks, and they brought back the rule, or they revised it and reinstated a limited version of the uptick rule. All right, so I have a few minutes left, so let me just talk briefly about the Dodd-Frank-Volcker Act rule and how it relates to the iron law. So what is the Volcker rule? It restricts banks from engaging in specified risk-taking activities, proprietary trading and investments in hedge funds or investment funds, with some exceptions, right? This is a very broad delegation, right? So does Congress define what it meant by what it was calling illegal? In fact, it didn't, and it had these exceptions for legitimate market making versus what's proprietary trading and the like. So there's very vague language here, and there's big gaps and ambiguities in key definitions, such as what's a trading account, as well as sort of what do we mean by legitimate and illegitimate trading, that were so they're related to exceptions in the statute that were given to the regulators. Well, they also delegated this to 5 regulators. Right? Although they were supposed to adopt it by 2011, of course, did it get adopted by 2011? No, they didn't even have a proposed rule by 2011. So they had to coordinate this. And in fact, the current conformance date when the banks have to comply, although they've already started, right, and been selling their trading desks and the like, is in 2016. The rule itself that they came up with, single-space, triple-column pages in the Federal Register is almost 300 pages. Someone tried to sort of convert this to regular pages and said it was like 900 pages, so how could anyone possibly understand this? Now, the UK has adopted a ring fence, so that we sort of arguably had ring fences and didn't work here. So they sort of looked at this and decided not to go with the Volcker rule and instead to just make banks separately incorporate their retail from their wholesale investment. It basically is a rule, we should note that sort of after it was adopted, right, so after it took these years and they came up with this long-page rule, then they found that they had regulated or counted something that banks couldn't hold called collateralized obligations supported by trust-preferred shares, which small community banks and a lot of smaller regional banks used as a key part of their financing and their investments. And so this rule was going to make them all of a sudden, they have to sell them, the value was going to go down, and they were all going to be in violation of the capital requirements. So within like a month, they changed that rule and revised it to exclude that item. So no matter how much they spent, there was already immediately an unintended consequence that they had to adapt. Right? So how would sunsetting and experimentation benefit us from that? Now, it's interesting, that was a revision, right? But there was a huge lobbying mass by this, and the regulators themselves don't want, banks that they have to close, right? So they did respond to that. But sunsetting would facilitate and accelerate revision. So in these definitions about what is legitimate trading or not, we can expect there's going to be litigation, although banks don't usually litigate against their regulators, but there's going to be a lot of uncertainty and issues that are going to come up. And what happens if one agency defines it as X? Will all the other agencies define the same way, right, of these ambiguities? Right? So if this is going to come up, if we have to sunset it, that gives a clear opportunity that forces the agency to deal with things that may have unintended consequences about how we define these things, or how better to define something. It could be the definition was, the exception was made so broad that, in fact, the banks can continue to trade and we want to sort of tighten it up. Those kinds of issues would be forced to be on the agenda if it's sunset. We could also then think about this, is the agency could have sort of randomly assigned some banks to ring fence and others to follow the Volcker rule to see the consequences. Now, as I mentioned before, that would probably be politically infeasible. But what we could do in the sunset is we could do an observational study. It's not as good, of course, as a randomized experiment, to see what were the differences in banks in the UK compared to US banks operating under these different approaches to dealing with tail risk or systemic risk, and see if one was more cost effective than the other, or one had better results than the other. Right? If ring fencing obtained the same results at lower costs, then if we were sunsetting and we had this information, we would want to sort of revise the Volcker rule to move to the UK approach. Let me conclude, so I have time for questions. To conclude, effective regulation of financial institutions and markets is challenging even under the best of circumstances, right? Given the uncertainty of the markets in which these institutions operate. Foundational legislation, though, and its implementing regulations are typically adopted, I should say invariably adopted, in the aftermath of a crisis. Doesn't mean that all crises result in regulation, but we don't tend to see large legislation or activity by Congress unless there's been a crisis. And this is a low information environment in which it's not very conducive to high quality decision making because we don't know what was the source of what we're trying to solve. Right? And that means what we've gotten in response is a layering of regulation, increased complexity. And this is not just by sort of the US. If we look at the Basel rules and how banking regulators themselves have responded, the Basel rules at one time in Basel I, you could like read them in a few pages of what you had to do, and now they're so long, I sort of look at them and don't see how any one person in a bank could figure out what they have to do. They need tons of staff, right, to tell how much capital and what kind of capital they need to hold. So we've just got this increasing complexity and opacity in regulation. How can we mitigate this? Sunsetting financial legislation and the implementing regulation in conjunction with fostering regulatory experimentation that can inform that sunset review, can improve decision making and aid in then mitigating regulatory failure, my iron law, so to speak, by facilitating timely updating of what may well be inappropriate and inadequate regulation. Thank you. So I don't know if there, I know we're running late. I don't know if there's time for any questions. If there are any questions?
Let's take questions, yeah.
Okay. So, yes?
Yes, our keynote speaker yesterday, Wilbur Ross, was rather disparaging about the Consumer Protection Finance Bureau, and that it really was unaccountable. I think he spoke as much about predatory borrowers, which we don't often hear about as predatory lenders. So I hope you could comment on that, and if you could.
I'd be happy to. So that was my alternative choice to use as a problem with Dodd-Frank. So another sort of key crisis response is to reshuffling of the bureaucracy and create a new agency. And I actually one time had a slide of like every sort of financial crisis and every legislation, a new agency was created. The CFPB is actually one of the most unaccountable agencies ever created because it has the Congress has no appropriations authority over it since the statute was written, so it just gets X% from the Fed to endow it and to spend. But it also has an atypical structure because it's structured as though it was an executive cabinet. Most independent agencies are bipartisan, commission-based structures, and it has one director, right, who's not, even though, doesn't serve at the whim of the president. He's got a fixed term. So normally when we think about a cabinet agency with one head, they serve at the will of the president. So they're accountable to the president, you can get rid of them. Or they're accountable to Congress because they're a bipartisan agency and they're adopted. So it's got neither of those structures. If we normally think about what agencies are free of the budgetary process, the appropriation process, there are agencies like the Fed, which has a narrow objective. So there are a couple of financial agencies that have this. And there's a very narrow objective, so Congress you don't have to be worried about that because what it's doing is not something that they have to control. Now, I guess we might say, Congress is currently worried about the Fed because it's not just, looking at inflation. But in general, that's how they work, whereas the CFPB has an extraordinary broad mission, right, an objective. So its structure is a problem. Now, if we were to look at actually what it's been doing, right, so in the statute, so there are different ways in which agencies act. And the way sort of that, I've been talking about and the sort of our idealized thing in the Administrative Procedure Act is by what we refer to as informal rulemaking by notice and comment. And that means there's a process of the statute that says that the agency has to go forth, get public participation, they give you comments, then they respond to the comments and adopt the rule. And when Congress, in the Dodd-Frank Act with respect to the CFPB, they gave a set of criterion that the agencies are supposed to follow in the notice and comment process, which included taking the consideration of the banks themselves, not just the consumers, but the cost to consumers of the products. And they have to do, in short, a cost, in summation, a cost-benefit analysis. What has the agency done? Well, there are a couple of things that Dodd-Frank required them to do by rulemaking. But apart from those, in general, they've adopted other approaches by guidance or by enforcement actions. What does that mean? Well, that means they can avoid, number one, the public participation process. They also get to avoid judicial review. In the note and comment proceeding, an aggrieved person can sue, right, to say they didn't comply with the rules. Now, oftentimes you don't win, right, but they can bring it in. The D.C. Circuit has actually struck down a couple of rules that the Securities and Exchange Commission has adopted for not complying with cost-benefit standards. The CFPB has avoided that. An example is, I don't know if you follow, the Wall Street Journal has been covering this in their op-ed page, is they've been trying to regulate sort of the way that car dealers give out loans. And that car dealers have discretion, and they've looked at some data. Now, there's no data that actually relates the ethnicity, the actual ethnicity of a car buyer to the deals that they get because the government has not required racial information, right, about cars. They required about housing loans, but not that. So they've done some statistical analysis with Social Security, it's not Social Security, for like census data and they believe that automobile dealers are discriminated against minorities. The statute forbid them from regulating automobile dealers in this context. So what do? They have power over banks. So they issued a guidance to banks, saying banks that if you give loans to these dealers and we think the dealers are discriminating, we're going to prosecute you, bank, even though the banks are not the loan dealers. And they've done this, though, not by notice and comment, where then they might have to show their data about showing their evidence that there's discrimination and banks to respond. But they've done this by a guidance. And the courts do not let you sort of oppose a guidance because the guidance is not a mandatory rule, so it's not clear it's going to apply. But they've actually enforced it against one or two banks, like Ally, I think it was Ally Financial is one of the ones. So they've acted in these ways that, in my opinion, more accountable agency would not be able to do as much. All agencies avoid it. There's a debate in administrative law about the new notice and process and comment process is time consuming. And so people debate about that as opposed to sort of, people say the democratic process, Congress intended for people to participate. But I think that this agency does more of that. They also act by enforcement. So another thing was they didn't like the fees that banks charged for certain things like overdraft. Now, maybe the banks really were charging too much. I don't know. But maybe some people were willing to pay for that because they wanted the security of overdrafts. But they just wanted to get rid of it. They brought an enforcement action against one particular bank. And that bank, so banks typically do not like to sort of litigate anything. Particularly, you can never litigate a criminal charge because your reputation is gone and you have, your business is gone. But also that regulator keeps regulating you. They have other dimensions. So if you object, they'll get you some other way. So the banks, all of the banks, a bunch of banks just stopped offering these products as soon as it brought one action. But did it do this by sort of, we would normally think this is a substantive rule that we would want to do by this other process. And I think when you're not an accountable agency, you can do more of that. If you had it sunset, they could sort of say the agency would then be less likely to act in a way that wasn't taking into account the notice and comment process, because they might end up with Congress then sort of saying, okay, now we are going to, since you're expiring, we are going to have to do something about how you regulate automobile dealers. Maybe they should get that jurisdiction, right? That might make more sense than doing it indirectly against the banks, right? If we think there's discrimination, we should get it there rather than how the banks, the business model of the banks and their regulation, right? Because all this does now is the banks then have to sort of police these dealers or change the business model and say, the dealer, I'm going to tell you what rate to charge, right, for everybody. Right? And that's not clearly, or at least if we think about that, that wouldn't seem to be the best process. So I think that is really one of the things that is a problem, right, with Dodd-Frank, that a sunset rule would adapt. Now, of course, if we had a massive change in the next election, the CFPB probably would be restructured as an independent agency. Of course, there was an issue whether we really needed a new agency or the SEC or some other existing agency that dealt with sort of consumer financial products couldn't have been the right agency to deal with these issues. Right? The other odd thing about the CFPB, it's given authority as though it's a bank regulator when we're worried about consumer products, and you might have thought we wanted to regulate the products in the consumer aspect of the market rather than supervise them as a bank, which subjects the banks to two different supervisors that are examining them for different purposes. Right? So I think I can understand why he was objecting that. I don't know about predatory borrowers, so putting that aside, right, about this, but I think it has some severe issues. And it's hard to know. If you looked at sort of the administration's proposal, the structure was not actually part of the Obama administration. And they got this. This is one of these recycled ones because Liz Warren, when she was a law professor at Harvard, had written little papers saying we should have a Consumer Financial Protection Bureau. But her objective on that had nothing to do with mortgages. It was on credit cards. And she wrote a long law review article with someone else, a behavioral economist, right, to show like behavioral problems about how people bought credit cards. Right? And so that was sort of the basis. And so when this came up, right, and we have Dodd-Frank, here's her pet idea, and this got stuck into the bill. The administration adopted it. Although the Bush administration, to be fair, they had suggested in their blueprint they wanted some agency like that too. Right? So this is sort of on our let's redo the agencies, a recycled proposal that got in. So that's my short thing on the CFPB. I think we're time for a break.
Okay. One more question. Okay. Hi, I'm Patrick Fitzsimons. I'm an alum of the graduate school and the School of Management. I thoroughly enjoyed your talk. I spent most of my career on the street, but I did take a 3-year stint with one of these creatures of Dodd-Frank in the Office of Complex Financial Institutions at the FDIC. So I got to see a little bit of how this sausage was made, and I think any ideas for taming the administrative and regulatory state are worth considering. One thing that I wonder about with your proposal, in particular the sunsetting, is the extent to which it seems that that sunsetting would create more volume of legislation or legislative activity. And in so doing, does it kind of make it even more of an insider game, such that the interests that have an ability to maintain a constant presence in DC are able to kind of work more under the radar, kind of create more opacity in the development of regulatory and administrative rules and procedures, and if that the kind of the public being kind of unplugged from that process, because as you say, these things are so complicated. It's kind of it's a miracle when the public can get focused on any of these, any one of these issues that we do manage to, we manage to do it a couple of times a year or a couple of times on administration, but I wonder if the public has the stomach for being able to stay on this constant regulatory churn.
Well, so I think actually sunset review would provide more transparency and publicity than the existing regulatory process. So my view is if you have this bipartisan independent review panel that publishes a report, that's something that we would expect the media to cover if they do it as a hearing when they're reporting to Congress. So there'd be actually, I think, more publicity than if we think about the VOCA rule, although there was some coverage like, oh, they're doing something, but the actual notices and comments that the people sent, the industry or the public that sent in, that was not something that was covered or looked at. So I think the normal regulatory process, and probably even the normal sort of drafting process, right, does not get the coverage that, in my understanding of how a sunset review, an effective or an appropriate sunset review would work, would, I think, bring more transparency to the process and keep it in the front page. I mean, it's an interesting question about whether it's more legislation or not. I suppose, it does mean at some, 5 years, let's arbitrate, let me take an arbitrary year. 5 years from now, we'd have to review this. Of course, if they have to review this, that means they can't do something else. So maybe it would be less. Maybe that's why Congress didn't want that, right? Though I think part of it, we could think of many incentives, and we may think, we got to pass now, and we won't be able to pass it later, so let's not have it reviewed. But so there is some trade-off of the time of a legislator. And having a review panel is supposed to not take away from them passing other things that's needed to be passed. So I think that's an interesting question. I don't really have a good answer or a guess on whether that means, it would certainly mean there's a lot of, if we think of, so I'm just now proposing it sort of for new ones, but retrospective sunsetting is also very, very important here, right, in thinking about that, and how you sort of get that on an agenda, right, of, again, the Congress is divided, the industrial organization of Congress, it's by committee, so a lot of this work would have to be by committee, and assuming that, the members of the Congress are electing committees that they think are, independent committees or whatever, have representativeness as opposed to special interests, maybe that protects this somewhat.
Well, thank you very much.
Thank you.